Last week, oil prices regained their strength as the situation in Iran appears to be moving in a more aggressive direction, potentially even toward a ground war. Over the weekend, Trump issued threats once again, hinting that action may be seen within the next 24 to 48 hours. If the conflict does escalate further this week, crude oil is expected to trend toward historical highs. The U.S.-Iran conflict has escalated, with Trump issuing a "our ultimatum" demanding that Iran reopen the Strait of Hormuz by April 6 or face disaster. Iran has responded firmly, announcing 8 strategic bridges in Kuwait, Saudi Arabia, the UAE, and Jordan as potential retaliation targets. Global energy security now faces an unprecedented threat. Core OPEC Plus member countries plan to raise their May production targets by approximately 206,000 barrels per day. This figure is identical to the increase approved during the organization's March 1 meeting, given that the war in Iran has severely impacted Persian Gulf oil transportation. This move is more symbolic than a signal of a substantive increase in production. WTI crude oil surged by over 10% on the weekly chart last week. After returning above the 100 mark, it has further begun moving toward major resistance levels. This week, the news flow will play a decisive role. If a breakout occurs within the core oscillation range of 76 to 119, it will signal the start of a new market phase. Only if Trump continues his rhetoric will oil prices have a chance to soften. The clear directions are ceasefire equals bearish for oil. Ground war or mutual bombing of civilian facilities equals bullish for oil. Overall, bulls are in control of the technical situation, and the final move is awaiting a trigger from the news. However, if a new high is not achieved this week, there is a risk of a retracement toward 100 or even lower levels in the coming weeks. Gold rebounded with a median bullish candle last week, while also leaving upper and lower shadows, suggesting significant market divergence. At the beginning of this week, gold prices saw a certain degree of a price gap, though it will not yet affect the balance of power between bulls and bears. News-driven factors will likewise determine gold's performance. For pullbacks during the week, the primary support is first seen at 4,400, followed by 4,250. Only a break below 4,099 would resume the downtrend. The upside rebound target is near the 5,000 level, and a major peak for gold may have already formed. The US dollar once again refused an effective decline last week, leaving a long lower shadow while returning to trade above 100, driven by oil prices. Whether it can achieve a greater breakout this week requires guidance from oil prices. Technical indicators show little change. If it effectively stabilizes above 100.42, a potential large double bottom structure will emerge, with a theoretical bullish target pointing toward the 104 level. For a pullback, the weekly low of 98.49 must be breached for bears to have the chance to initiate further downward movement. Long-term weakness and pressure on the dollar remain, but only when the market realizes the end of U.S. hegemony will dollar assets encounter true selling pressure. U.S. stocks performed decently last week. After an initial decline and subsequent rise, the bullish candlestick body showed an engulfing pattern, temporarily stabilizing the situation. However, this does not mean the correction is over and the rally has restarted, as 6,520 has begun to turn into resistance after the support was broken, and a valid break back above it has not been confirmed. The struggle around this level will be the main highlight this week. A pullback after a rebound would imply a bearish continuation, with more downside room to follow. Conversely, there is a chance for a rebound toward the vicinity of 6,800. In the medium to long term, however, it remains difficult for U.S. stocks to quickly return to a slow bull state while high oil prices persist. Bitcoin rebounded with a small bullish candle last week. However, compared to the declines of the previous 2 weeks, the inside bar Harami pattern suggests that the short-term movement has limited overall significance. While recent price drops and volatility have not been substantial, a distinct characteristic is that crypto assets are struggling to maintain their previous relative resilience. In the coming weeks, especially this week and next, if other assets remain under heavy pressure, the crypto market is expected to see a catch-up decline. However, a break below the 60,000 level would be required to accelerate the downside. On the rebound side, the struggle near 74,000 represents the first resistance, and the double bottom theoretical target at the 80,000 line is not expected to be reclaimed.